Hi, my name is Ben Shepard and I'm the editor of Global ETF Profits. On March 25th, the Securities and Exchange Commission put a halt to reviewing exemptive orders for exchange-traded funds that make extensive use of derivatives. And I know that probably sounds a little esoteric and out there, but that's led me to really look at commodity ETFs because that's really the area where you would expect to see a lot of derivatives. And that's because for most types of commodities, it's really just not practical for asset managers to hold, a tanker full of crude oil sitting offshore or, storage tanks full of natural gas. Really, the only kind of situation where it makes sense to hold a physical commodity are with the bullion funds that invest in maybe gold and silver and some of the other metals. But when it comes to liquid and agricultural commodities, it just doesn't make sense. So in that context, you do tend to see a lot of derivatives use, particularly futures contracts. Most ETF investors are probably familiar with the U.S. oil fund. And basically with that fund, what they do is they buy future month contracts. Typically the next 3 months futures contracts of crude oil will be held by the fund. And then they'll make some use of, swaps and other derivatives to leverage it up. What this order means, though, for commodity funds is that it's going to be much more difficult for the managers to actually do their job. And again, just as an example, we'll go back to U.S. oil. Based on their structure of buying the next 3 months contracts, basically what that means is that they're subject to contango, where you get a price curve where the future months are more expensive than the current months. So as the manager is rolling those over, basically the fund is slowly bleeding value for investors. So that means even when prices are bullish for crude oil, investors could actually lose money with the fund. That's why the use of derivatives is really key, and it's kind of worrisome to see the SEC put a halt to approving new funds that use them. And that's because by giving the managers more leeway to use derivatives, that gives them the flexibility to avoid issues like contango or backwardation and other things that can really pose a major challenge for investors. So you can't argue with the logic, though, and there's a really clear-cut example of why derivatives can be bad. In 2008, as real estate prices were plunging, everyone was looking for a way to make a bearish bet on real estate prices. Lots of hedge funds made just obscene amounts of money going short real estate. So that led a lot of folks to the ProShares Ultra Short Real Estate Fund, which was basically leveraged up to provide to return twice the inverse performance of a Dow Jones real estate index. Oddly enough, though, investors lost a lot of money with what should be with a fund that should be making money for you as the markets are declining. In fact, they lost money to the tune of about 80%. Even as the index lost about 60%. So an investor in the ProShares real estate with 2 times leverage should have been able to expect to make about 120% on the fund. And then when the SEC, of course, based on those losses, investors began to complain, and the SEC started looking into it. And the real issue is that the fund calculates its returns on a daily basis. So all it takes is a few moderately up or even flat days here and there to make the fund lose money over the long term. And those kind of situations is what raised the red flag with the SEC about derivatives use in ETFs. So as investors, what does that mean for us? Well, that means we need to be cognizant of funds that use derivatives, because that means they might not always behave quite the way we would expect. But that doesn't necessarily mean that derivatives are bad. In fact, if a manager uses them to the right ends, they can actually be a huge positive for us, particularly if we're investing in commodity ETFs. So really, this is just an issue that we should be aware of, and investors should keep an eye on. And if you're so inclined, currently the derivatives use in ETFs the SEC's rules on that are open to comment, so you can go to sec.gov and let them know what you think and provide them with some feedback on that. Again, my name is Ben Shepard, and I'm the editor of Global ETF Profits.